and get a net price and a actual forecasted stock price for around a 5-year cycle. So it's going to be pretty interesting. I'm just going to start by sharing my screen right now, though. Let's see. You guys should be able to see my screen. And everyone can hear me okay, right? Okay, great. Welcome, Ranesh. We're gonna get started right now. It's 8:05. Just everyone, make sure your mic is muted. I'm gonna have questions at the end, just for recording purposes. So we're gonna get started right now. All right. So right now, this is what I call. So I created this model right here. You guys can see it. It's called the simplified cash flow model. I changed the name here. But this simplified cash flow model is a combination of both the income statement and the balance sheet. All right. I also include the cash flow statement down here, but the cash flow statement is less relevant when we're doing this because it's a lot more complicated. Okay. Typically, you create discounted cash flow models, but this is a like an alternation of that in which you still can use income, net income, and your balance sheet to get a better understanding of what the current price of the stock could be. Now, we're just going to go back from what we learned in webinar 2 real quick before we get into that. So just remember that we did this stuff with Ion. That stuff's kind of more the basics, but we also did discount rates and risks. Okay, so if you remember, we calculated what is the present value of your dollar, right? So the present value of your dollar depends on the discount rate. When you invest in a company, when you go back in time, right, and you have the same amount of money, you have a better opportunity because you can invest. We looked at this, like, for example, in 2018, you would be better off with $1,000 than in 2024 because you could take that money and invest, right? So basically, you also have to consider inflation, of course, but we did consider that. And looking at that, we found that if you would have invested that $1,000 in 2018, you would now have $1,477, roughly. And that does include inflation, right? All right, so that's just a quick summary of that. But then we moved over to net present value, right? I remember we had a few questions about this, and it is a little bit more complicated calculating this. There's more meaning to it. Obviously, as your years go on, your money declines in value, right? So that's because of inflation, right? The average inflation rate is around 3%. So we remember we use that average inflation rate as a discount rate. When we use a discount rate, we are considering inflation, but we are also adding risk to that, right? So we moved over here and we added risk to that. We said that HPQ, because of market conditions, would have a discount rate of 7%, right? So that was 3% plus another 4%. Now, how did I know that it was 4% that was our risk, right? How did I know that? I don't know that. That's the thing about finance. It is theoretical. You have to make assumptions. And that's why I added that 4% as our risk. But by doing that, you get a better net present value. You remember that the sum of your forecasted net incomes times your, or yeah, including your discount rate gives you a net present value. And we also included maturity. Um, your maturity depends on it. We did have problems with the maturity rate, I remember. It is a very complicated topic, but I typically set it as -1%. All right, no, I hope you guys are listening right now because we're gonna be using that here in our actual model in a second. The maturity value, it depends on what you think is going to happen in the industry in the future, right? You cannot continue making assumptions for a company's income after 5 years. That goes too far in the future. and therefore you're probably going to make faulty assumptions, and that's where you set the maturity value, right? So at fiscal year 31, after I was done forecasting these high growth periods, I set it at -1%. And that's just for reasons because obviously your company isn't going to end. It's not going to be gone at fiscal year 30. I really hope HPQ isn't a defunct business in fiscal year 30. You can't just stop your cash flow here. You got to continue it. But the best way to continue that is not to make these like crazy assumptions because you really don't know what's going to happen in those fiscal years. So, and that way you just set the maturity value. And that's kind of where that -1% comes in. All right. So that's just a pretty brief summary of that. And this webinar is probably going to be the most interesting one. Um, I love this cash flow model. It really does work. I can say that it's worked for me multiple times. I'll show you an example right now. So this Nike, this is a little bit more complicated. It still uses the same assumptions though. I just basically simplified it more for you guys just for reasons. Um, and all of these boxes, by the way, are just like values you have to fill in. You're gonna see them all over. The boxes just represent, so the red, they have formulas. Obviously, with Excel, you can use formulas, right? So that's just what the red and green means. The green means you would have to type in the numbers physically, and the red boxes mean that it's a formula that covers that area of the model. Okay. So let's just look at this Nike version I did. So this is just the income statement and the balance sheet. And I've talked to a guy actually, I talked to him at Merrill Lynch, and he was very, very surprised that you could actually do this. He was like a second year, but he was very surprised that you could do this with only income statement and balance sheet considerations, right? I I'm not going to not give credits to who I learned this from. It was a Martin Shkreli. He's on YouTube. You can find him. I do recommend his videos, but his stuff is a lot more complicated. He worked in the hedge fund business for a while, so I just use a model similar to his, but one that can save me a little bit of time, right? So this version is a little bit more complicated than the one we're going to do. But let's just look. So I made this model in November of 2023, right? Now, at the time, Nike was trading at $107.64, right? Now, you guys can go look up what Nike's trading at right now. At the time, I said, with my considerations on the model, that the company should be trading at $80.16. Now, we'll go look at it right now. Let's see what Nike's trading at. Nike's trading at $72. So obviously, your model isn't going to be spot on. But I just assumed a short on Nike with my model, which is outstanding. These models are hard to use typically to make realistic assumptions, but as long as you can assume that there's a present value there, a you can really get a somewhat decent estimate on either up or down. Sometimes, like for I think it was Volkswagen, I got like a crazy amount. I ended up finding there was an error, but it was still pretty surprising how undervalued the company is. That's really what we're just going to be doing with this model, though, is just finding whether the company be undervalued or overvalued, right? With Nike, it was trading at 107 when I did this model. And with all their cash flow with their, well, not cash flow, right? Their income statement and balance sheet considerations, I found the company to be worth $80.16. Okay, so this formula for this will be represented in the simplified version of this. And I'm going to go through a whole company today, guys. So it's going to be good. Let's see. So we'll go back here. All right. So now that that's out of the way, we're gonna get started. So I know most of you guys are familiar with Yahoo Finance. I showed it the last time too. I don't know if he's in here, but that's fun. He created a great little model here, right? And I wanted to show this as well. You know, he makes all of these, he writes all of these numbers down, right? Which is great, which is great. But he does not make assumptions for the stock price value. And that's what we're going to be doing today, okay? So it's gonna make a lot more sense putting these numbers to actual use, okay? All right. So let's move over to, we can get rid of that for now. Let's move over to this. I'm also going to place a template of this in the Slack after this, so you guys can use that at any time. All right. So I get my data from the SEC, the Securities Exchange Commission. I think I mentioned this the last time, but all you do is you do this. So you go SEC, right? And then any, this is all information they have to fulfill every quarter and every fiscal year, right? So the 10K is what we want to look for. The 10K is a annual fiscal year report, including all the financials from the fiscal year, right? So if we go in, let's see, our model makes assumptions with fiscal year 18, fiscal year 19. Okay. So we're going to go in and we're going to look for the report fiscal year 2020, because that means it would be, since you can see the date, it's February, that means they're reporting financials for fiscal year 2019, because that's the just the start of the year of 2020. So we go in here, we open this document, just watch this again, just so you guys know how to do this. There's a lot of information on the SEC because they have to submit all this information, right? But what you do is you just look for this, you look for the 10K. If it's not there, you're not looking in the right spot. So you just click this little link here, and then you're into the statement. And just a second, guys. All right. All right, so now that we're in here, we can see that this, like I said, it's for the fiscal year ended December 31st, 2019. All right. So now we know that we're looking at 2019's fiscal year financial statements. All right. The SEC is similar to what the companies file on their investor relations part of their website, right? They include information for investors too, their organization. We can see that NEE, it is and oh yeah, by the way, just a background of NEE real quick. NextEra Energy, it is a utilities company. Over, let's see, past couple years. Well, actually, since earlier this year, it's been up quite a bit. Well, this gives a bad reading, but it has gone up a lot and has recovered. I'm looking at utilities in specific because of data centers, just so you guys know. That's just my consideration for the utilities. All right, so back to this, all right? So now we know that any, like I just said, it's a utilities company. Great. All right, we can see it has multiple subsidiaries, Gulf Power, NEECH. Okay, I don't know what NEECH is. All right, I just look right here. Another wholly owned subsidiary of NEE, owns and provides funds for NEE operating subsidiaries. So a lot of these companies are broken down in like multiple ways. NEE, you can see it's at the top, and it just goes down from there. All right. So you can see all that information on the SEC, which is great. They file this every fiscal year and is updated all the time. We can see, oh, I love these charts. I love these charts so much. We can see that natural gas for the fuel source is 79%. So I know you guys might be familiar with Roaring Kitty, right? Roaring Kitty is really profound, and he looks at these stuff because he's a deep value investor, right? He might look at some of these graphs and say, well, that could be better. And he finds a company that does that better. right? He looks really deep into these companies. He looks at stuff like this. And that's what I want you guys to be able to do from learning about this. All right, so just a brief summary, this thing is full of information. But what we're really looking for is the consolidated financial statements. So what I typically do is just Control F, and then I look up consolidated financial statements. And I just click through until I find them. They're going to look something like this. They always look like this. Consolidated statements of income. Okay, great. So I just got the consolidated statements of income. All right. So what I'm going to do next is start plugging these numbers in. Finance, some of it is monkey work. You gotta do this stuff. You just gotta type the numbers in, right? It's not super fun all the time, but gets you somewhere. So we can see operating revenues for 2019. I'm putting these 19,204. I just put it there, right? Because fiscal year 19 total revenue. All right. Also, we need 2018, so we'll get that. 16 2 or 727. Sorry about that. We need net income next. Net income is going to be down here. Not operating income. Net income is actually 3769. Oh, I'm also going to show you guys that project I'm working on. That's going to automate this eventually. It's gonna take a while, but we're just gonna keep going for this. So we got 2019 net income is 3769. 3769. Plug that in. Look here, and we got 6638 for 2018. All right, great. Got those. And now we need shares outstanding diluted for fiscal year 2019. We're gonna find that. Let's see. Shares outstanding. Whoops. Basic. Okay, so these are millions. Oh yeah, that's also something to consider when you look at these. They emphasize whether they're in millions or not. And we also do that here. We need to say what we're doing all of our numbers in. It is going to be in millions. This company, that's how they report their financial statements. So make sure every number, the shares outstanding, net income, and total revenue, you have to make sure those are in millions if the company is doing millions. A lot of the time they're going to do thousands, but if they're doing millions, make sure everything's in millions. So what that means is you just get rid of 6 zeros, right? All right. So we're going to look at 2019. So let's see. They have shares outstanding, assuming dilution. That's what we want. They have 485.5 million shares outstanding. Okay. And then they have 477 for 2018. Okay, so we got those numbers in. Now we're going to look at our balance sheet. Going to do consolidated. We got to go back. Balance sheet. Consolidated balance sheet. Okay, we're here. Total assets. I know that balance sheets are supposed to balance, of course, but when we're doing this, assets is not going to equal your liabilities. Well, that's actually not true. I take that back. Assets equal liabilities plus shareholder equity. So, but when we do this cash flow model, we do not assume shareholder equity, or what I mean by that is capitalization. It's not part of that. We're assuming total assets and total liabilities, just for reasons. All right, so we're going to look at our total assets. Now you have to be careful sometimes. It's sometimes hard to read this. Some of the numbers are really small. 691. And we'll go back here. We got 103,702. And don't worry, I'm not gonna do this for the whole entire webinar. I already finished this model a while ago, so I'm just gonna show you guys how to find these numbers though. All right, so now we get down to something like cash. All right, so the thing is about the SEC is they don't always perfectly specify where these numbers are, right? So what you have to do often, what I do often at least, is I go in and I look at 2022's. Here, I'll do it right now. So we go in, we're going to find 2022's because we don't see the problem is we don't know. Yes, it says cash and cash equivalents, but you have to consider other numbers in the cash section, right? I can show you this. So financials, because things like marketable securities and notes payable are also actually considered cash because they are very liquid, right? Cash is liquid. It's a liquid position. If you can get out of something today, right now, then it's liquid. Therefore it's cash, right? So we have to consider these other aspects that are also cash. So we're going to look at our total assets, current assets, cash and cash equivalents. Actually, this number might be right. Let's see. I can just look at my model that's already complete too. Where did it go? Not this one. This one. There it is. Oh, okay. Actually, that is right. But sometimes the cash that's not going to be right, and you have to look around a little bit more. So I guess this is kind of a bad example of this company, but that's all right. Because most of the other stuff's good. All right, so now we move down to total liabilities. We go back to these 2019, 2018, right? And we look down at total capitalization. See, like even me, I get stuck on these a lot of times. They have to file a lot of information in these, so I think for this one I would do current, and then I would add this. Yeah, those two. Okay, so 1385, 13, and just if I do like put one in the wrong column, I probably will, because I'm doing this really fast. Don't worry about it. I already have it complete. I'll show you guys when I'm done too. 2448. 44. All right. So we got those. Whoops. Whoops. Oh my god. Falling apart. 13583. Okay, just double check. It's a little hard to do this while I'm talking, but that's okay. We got, okay, so from there we just got fiscal year 19. We got their total liabilities, right? I had to look around a little bit, but after looking at this, I found that they report current liabilities right here, and they report other liabilities. So I added those two together, and that's my total liabilities, right? It's not, see, the problem with the SEC is that these numbers are not always going to be the same. Companies are going to use very, very bizarre terms to describe some of these. We can even see on this, right? We can look. Okay. Accrued construction related expenditures. All right, what even is that? Is it R&D? I don't even know, right? See, that's the problem with the SEC is that they have to be very specific, especially for some of these larger companies. They have to say specifically where some of this money is coming from. So like accrued construction related expenditures is most likely not going to pop up on a Apple's consolidated statements of income. Apple's are actually really, really simple. But that just kind of shows like how complex these SEC statements are. But they have to make them complex, and that's why the SEC is probably the best place to get your financial statements. You also might recognize I did say this just a second ago, but I didn't use total capitalization. Oh, I apologize. Long-term debt also I missed. So I would add this 37,543 to this as well. 37,543. And that gives our total liabilities. Yeah, that's more reasonable. All right. So we got that, and I'm not going to do it for fiscal year 18 just for time purposes. So now we're going to move down to total debt for fiscal year 19. We just found that, right? Also, the same thing with debt and cat is similar to cash, where you have to look around a little bit. So we're just gonna briefly look through this to see if there's any other debts that aren't expressed as debt. I know that does not sound fun. Typing in financials is not a fun thing to do always. I enjoy doing it. Most people don't. I could see why. It does seem like something that can be easily automated, but as of now, you have to pay a lot of money to automate it. So for now, we're just going to use this though. So long-term debt is going to be right here. We use that in total liabilities. All right. So we're saying it's 37543. But I believe that commercial paper is also going to be a debt and of course short-term debt. So we're also going to add these two numbers to it as well. So 2516 and I think it was 400. Yeah, 400. All right. So that just gives us a value for debt, right? All right, free cash flow. You know, everybody, all right, so it is a discounted cash flow statement, but ours does not use cash flow. And that's just for reasons that I want you guys to make your income statement knowledge and your balance sheet knowledge. I want that to be perfect. We really don't need cash flows yet. This model works without it. So for now, we're just going to basically skip this. And that's okay if you guys use this template and you don't include cash flow at all. Free cash flow, it's just capital expenditures, or I'm sorry, operating cash flow, uh, let's see, plus your capital expenditures or minus your capital expenditures, right? I don't even know. I don't even know because I don't use the cash flow statement, right? I only use the income statement and the balance sheet. All right. Okay. So now we just found that fiscal year 2019, we found that whole column, right? We found our debt, we found our liabilities, and we found our cash, we found our assets, our shares, net income, total revenue. Okay, great. Now it seems like this is super simple. And it is super simple. That's why I call it the simplified cash flow model, right? So what you would do next is just find all of these columns. You can go back into the SEC and you can look for these. We need 2023s eventually, so you'd go in here and just do the same thing again. Look up consolidated financial statements. And let's see. There they are. Same thing, just for fiscal year 2022. We got those. Balance sheet, everything's here. And from there, we do exactly what I just did in 2019, except we would put them in for 23, fiscal year 23, and also fiscal year 22. All right. So that's the basics of it. Typing in numbers is, you have to be careful when you're looking at the numbers. They switch, like I said, they switch up the terms a lot, but as long as you do it roughly right, um, you're gonna get a decent forecast, right? Okay. So we got those numbers done. Um, okay. So a shortcut to that though is to not use the SEC. The SEC is filed by the government, right? That's why I use it. I always use the SEC. But what is a lot simpler is just using Yahoo. I mean, Yahoo already they put their financials down. I mean, if to look back farther, you have to pay. I don't pay for this because I don't think it's worth it. The SEC is free. but you can look farther back on Yahoo too if you pay. Um, you can use Yahoo for the current years though. What I do a lot of the time is I'll go through, I'll check that these numbers are right when looking at the SEC. And I have found times where Yahoo they put their numbers down incorrectly, which is a little scary. Um, so I would just be cautious when using Yahoo. Just double check with SEC. All right. So that was a lot. That was a lot, right? I just told you a lot of stuff. Typing down these numbers. I've not even mastered this. I've probably been doing it for like, well, since fiscal year 23, so almost for a year now, right? And I'm still not a master. This stuff is very complex. It doesn't look complex, but it is. When you get down to the like what is actually net income, it gets very confusing. Right? But this model does a great job at simplifying all that stuff, and that's why we're going to be using it. Um, all right, so we got NE, all right? I did say I have it done, so we're just going to look at that. I did it on Yahoo actually, but all right. So this is the completed version of NE. Okay. What I did first when doing this was I typed in the company symbol, exchange, NYSE, utilities, their current price, their dividend yield, market cap, cash debt, EV, right? All important values. I also filled in this forecast information. Okay, so let's see. So we can see that I used all those numbers from the SEC and I typed them in. I got rid of my boxes when I was done over here. And this is what I got. Got all this stuff. Okay, so we got that stuff. Great. This is great. But now we're going to look at that forecast again. Okay. So the forecast is the most interesting part of this by far. All right. You, as an investor, have to decide what you think your company is going to do in the coming years. Okay. So when I looked at NE, Next Era Energy, I was thinking data centers, right? I just read an article today that was interesting. Companies like Apple, Tesla, Google, Nvidia, they are going to be investing over, I believe it was $100 billion into data centers in the next coming years. That's that's a lot of investment. Okay. So with that consideration, I looked at the what data centers need. Data centers need energy. What does NEE do? They're an energy company. They supply energy, okay? So for that reason, I gave 40% growth for the company's net income in fiscal year 24 and fiscal year 25. Because that's when I think the most amount of investment in data centers is going to happen and the most amount of demand for energy is going to happen. All right. So we got 40% there, 40% there, 30% just kind of slowly declines a little bit because as when a company's revenue increases, excluding Nvidia, of course, their like their increase is going to slowly decline, especially a company like this, they're controlling a lot of the market. So like at a certain point, they're not just going to keep doubling, well, 40%. They're not just going to keep doing 40% times their revenue again. So that in that case, I just kind of slow the growth down a little bit, but I stopped that at fiscal year 30. So let me change the color just to make this a little bit more viewable. So that's my forecast. Okay, so I forecast up to fiscal year 30. So in that 6 year period, remember that Google Slides. what do I ask you guys always for? That 5-year target price. Okay. Now your 5-year target price is going to be used. That's going to be your 5-year target price. Because this is, well, it's roughly 6 years, but it's it's fine to say it's 5-year target price because you kind of slow down the stuff now. Okay. But you did not just stop your like I said with HBQ, we're really hoping the company doesn't go defunct in 2030. And the same thing goes for NEE. We're really hoping that NEE is not going to be defunct in the fiscal year 30. And therefore we just are going to provide that maturity value to it of -1%. Let's see how many years. 1, 2, 3, 4, 5, 6, 7. So I did it for, well, I need to strike this out. Up to fiscal year 41. And that's probably a good year to stop. Around fiscal year 41 to fiscal year 50 is a good time to stop your maturity. Um, with the maturity value, it's I like to be honest with you guys, totally honest. When my mentor taught me how to do this, when I watched all these YouTube videos, when I went through the course, when I learned from him directly, what he was explaining is a very complicated concept, right? Maturity value is hard to really put in place, but just for reasons, just use -1%. We're not going to get that far into it. I just want you guys to use -1% after fiscal year 30. Okay. So after you do that, you go in and all of these formulas are provided for you. You can look at all these formulas. We can see right here. What I say don't fill in and what I say fill in. And I want you guys to remove these when you're done with them. You fill in all this stuff, but you do not fill in the reds, okay? So anything that has red next to it, do not fill in. Okay. So let's go back to that. All right, so this goes back to webinar 2. We have our maturity value, our discount rate, and our net present value. Net present value, the formula is provided for you. You don't click anything for it. You just look. We can see here. I should drag this out a little bit more. It's taking into assumption all of these net incomes during this period. I'm not sure that that's not working. AC 30. Right. There we go. And it gives more weight. What it does is it gives more weight to the earlier years, right? So these ones. And it also considers your discount rate. Now, the discount rate is one of the things that you have to fill in. We discussed this. If you don't remember, what I would do actually before doing this is also going back and looking at webinar 2. But discount rate, we said it was 3%, and then we said it's you add on your risk, okay? So the utility sector as a whole, it's not really a risky sector. I mean, we are always going to have utilities. So that's why I kind of set it at 5%. So just an extra 2% to that. And at that point, you're at 5%, and that's kind of similar to the treasury numbers, right? That's around your rate for treasuries. And that is a good assumption. Um, your rate for treasuries is typically, well, right now it's at 4%. It's a little lower typically. But for reasons, we're going to set it at 5% because of those reasons. Now we remember that when we change our discount rate, it's going to affect your per share terminal value, or your net present value, because you're losing more money over time. It's assuming that there's more risk and the inflation rate is higher. So let's set that back to 5%. All right. So we got that discount rate, and I explained the net present value. Let me get a sip of water real quick. No, we did that last time too. But what we didn't do yet is net cash. Net cash, simple formula. It's your cash minus your debt. Um, this is crazy. Um, Utilities companies, they take out tons of debt. You're gonna find in different sectors that some of these values are very interesting. I mean, look at this. Their total cash is what is it? Two billion, yeah, $2 billion. But then their total debt is 73 billion dollars. So that's a big difference. That's just because of the sector. It's a really safe sector. We will always need utilities, so for reasons they take out a lot of debt. But it's going to be different for a lot of companies. But still, even with that debt consideration, this model is still pretty pretty darn accurate, I would say. Um, so we got our net cash. We said it's around negative $70 billion. And from there, we go to total value. These are all formulas. You do not fill in these numbers. The formula adds net present value and net cash, and it gives you a value for this company of $188 billion. And then from there, all we do is we're taking total value and we're dividing it by shares outstanding. Diluted. Dilution, if you guys don't know, dilution is insiders. It's also considering insiders. So I use dilution because basic shares doesn't consider every share. So I just use dilution typically. It's just adding insiders. They're considered diluted, their shares. So we're going to divide those two. Total value divided by your shares outstanding diluted. And what do we get? We get a per share terminal value. Okay, so terminal value. Why do I call it terminal value? I call it terminal value because I forecast with that negative 1%. This per share amount takes into consideration our forecast. It takes in consideration our net cash. It takes in consideration current incomes as being weighted higher, growth. It also considers our discount rate, which is truly all you need. Um, and in that case, we get that value. For this company, my forecast is showing that the company should be trading at $92.77 right now, not $70.81, what it is trading right now. So for those reasons, my projection on the sector for utilities and the company for Next Era Energy is that the shares will be trading at $92.77. That is a price target. We see Goldman Sachs, we see JP Morgan, they create these price targets, right? That is our price target. That's how they do it. They use cash flow more oftenly, but we use income statement and balance sheet, and it works just as great. We just got a forecasted share price. So, like I said before, Esteban, he had written down all of those values. Let's go back to that. And then you guys do the same thing all the time. Let's see. You know, you guys write down these values, you look at them and you're like, "Oh, great. Well, what does it actually mean?" With this model, we consider risk, we consider inflation rate, we consider everything, and we get a per share terminal value as a result. We get a real forecast, we get a target price in this model. And that's just basically the summary of this model. I hope you guys learned a lot, and that's just I think I'm gonna wrap up there. I think that's all we need. You're probably going to have to go back to this video. I provided a lot of information. And from there, I'm just gonna end the recording. Please stay in the Zoom for a second. Let me end that.